All right, here's an audit ethics simulation on Sarbanes Oxley. A quick review. The Sarbanes Oxley Act of 2002 created the PCAOB, and the PCAOB was created to oversee accounting firms that audit publicly traded companies. Prior to the Sarbanes Oxley Act, there was no PCAOB, and it was up to the large public accounting firms to self-regulate. Today we know that PCAOB regulates the large public accounting firms and the publicly traded companies that they audit. If you're an accounting firm that wants to audit a publicly traded company, you can't even do it without PCAOB's permission. But the PCAOB is not a government agency, and you may have to know that for the exam. They're not a government agency. They don't get a budget from taxpayers. But PCAOB does come under the jurisdiction of the SEC, which means the PCAOB board reports to the SEC, which is a government agency. So large public accounting firms and the companies that they audit both have to register with PCAOB as a result of the Sarbanes Oxley Act. So here's question 1 of our sim. According to Sarbanes Oxley, for auditor independence, the lead audit partner and concurring partner must rotate off the audit every how many years? And the answer is 5 years. According to Sarbanes Oxley, to promote auditor independence, the lead audit partner and the reviewing partner, known as the concurring partner, must rotate off the audit every 5 years. And that means the auditors must change. Does that mean my firm can only audit Walmart for 5 years and then a new firm gets the job to audit Walmart? No. The same firm can be retained. We're not talking about retention. We're talking about rotation. My firm can continue to audit Walmart long after I'm no longer able to be the lead partner. It's me, the lead partner, that Sarbanes Oxley is worried about. The risk is that if I remain the lead partner for many, many years, I'll become so well connected with Walmart that I'll basically be part of their team. So to promote independence, my firm has to replace the lead partner every 5 years, and I'd have to sit out for a timeout period. I would be put in timeout as the lead partner, and I could not rotate back in until enough time has passed. And that brings us to question 2. According to Sarbanes and the SEC, lead partners and concurring partners are subject to a how many year timeout period before returning to an audit engagement. So I'm the lead partner and you're the reviewing partner. We've just rotated off after the 5th year. How long do we have to sit out before we come back? And the answer is 5 years. So we rotate out after 5 years and we have to sit out for 5 years until we can come back again. And these rules only apply to publicly traded companies and their auditors. So if you see that the question mentions Sarbanes or Sarbanes-Oxley, then you know that the facts are pointing to a publicly traded company. So if there's an audit of a publicly traded company and partners have rotated out, they've got to sit in timeout for 5 years. Whereas if this were not a publicly traded company, there would be no rotation rule. So the lead partner and reviewing partners, they only have to rotate out and sit out for 5 years if this is a public company being audited. Number 3, according to Sarbanes and the SEC, other audit partners, other than the lead and recurring partner, should rotate off the audit engagement after no more than how many years? 7 years. That's for the other audit partners on the engagement team. So who's the 7-year rule apply to? Not the lead partner or reviewing partner, because they have to rotate off after 5 years. It's the other partners who are coming in to pick up the slack after the lead and reviewing partners rotate off. Those other partners, they themselves have to rotate off every 7 years, and they have to remain out, but only for 2 years. And these rules are to promote auditor independence, because without this, you'd have what we saw with Enron, where, to put it in 2022 terms, the CEO of Enron's kids would make TikToks, and who would be in them? some of the audit partners from Arthur Andersen, who became so friendly with the management of Enron that they would be at each other's homes and private functions. So independence is what keeps our CPA license the value that it is. Without the public's trust in our independence, what would we have? The CPA license would be worth little more than a public library card. So remember, when it comes to auditor rotation for public company audits, 7 years for other audit partners, and they remain out for 2 years, 5 years for the lead and reviewing partner, and they must remain out for 5 years. Let's go on to number 4. CPA firms that audit fewer than 5 issuers can be exempt from the partner rotation requirements of Sarbanes Oxley if the CPA firm has fewer than how many partners? 10 partners. So if they have fewer than 10 partners, Sarbanes understands that those firms are very small and they lack the senior staff to rotate partners on and off engagements every 5 years. So very small firms are allowed to have the same lead partner for more than the 5-year limit, and that's all you'd have to know. Number 5, according to Sarbanes Oxley, the Board of Directors of the Public Company Accounting Oversight Board, the PCAOB, is made up of how many members? How many members of the Board of Directors of PCAOB? It's a 5-member board. And the requirements to sit on the board of PCAOB is that 2 of the members must be or must have been CPAs. The other 3 members must not be CPAs. And remember, Sarbanes-Oxley created PCAOB, and Sarbanes-Oxley was an act of Congress. And Congress made a good move here by opening up the board to non-CPAs, but remember, they're financially literate people, but they're not CPAs, so they have different backgrounds. And there's always a benefit to being around financially literate people with different backgrounds, not all the same, not all accounting. So in case the exam asks, PCAOB is made up of a 5-member board. Question 6. A CPA can only act as the chair of PCAOB if they have not practiced as a CPA for the past how many years? 5 years. So let's say you become a CPA and they offer you the role of chairperson of the PCAOB. If you've been practicing as a CPA, you've got to sit out for 5 years, be 5 years away from your public practice in order to have oversight over CPA firms who audit publicly traded companies. And the reason for that requirement, the 5-year timeout, is because you may have left your firm a year or 2 ago, but you're still social with a lot of these people from the firm, and all of a sudden you're going to have oversight and governance over them. As chair of the board of PCAOB, you're going to be able to levy fines against individuals and their firms, or decide not to levy those fines. So that's why there's this 5-year timeout rule. All right, question 7 is about a covered member. Under SEC rules, covered persons include the audit engagement team and individuals within the audit chain of command. This includes any other partner, principal, shareholder, or managerial employee of the firm who provided how many hours of non-audit services? And the answer is, if you provided 10 or more hours of non-audit services to the audit client, or you expect to provide 10 or more hours of non-audit services on a recurring basis, then you would be a covered person as well. And if you remember, if you are a covered person, you cannot own even 1 share of stock in the client company. So remember, who covered members include members of the audit engagement team, anybody in the chain of command, which means somebody who put you on the audit. And if they put you on the audit, they could also take you off the audit and put you on a different company audit. Those people are covered members, and they can't own any shares directly in the client either. The firm itself is a covered member, but now we're also seeing that anyone who provided 10 or more hours of non-audit services to the audit client, that person can't own any shares. They're a covered member too. And this sim is taken right out of the I-75 audit course. Every sim in I-75 is narrated, instructor-led. I walk you right through it. And that's for maximum learning purposes. To see the rest of this sim, or if you need a little bit more help with audit ethics or any part of the CPA audit exam, go to cpaexamtutoring.com. Get yourself on I-75, where the right teacher makes all the difference.